So after a rip-roaring start to the new year, markets have kind of been in trickle-down mode, I guess I'd say, over the past week or so, where some of that upward momentum is sort of stalled out here. And so I guess the big question is this a sign of things topping out, or is this just the pause that refreshes before we head off to new highs here? What are your indicators telling you is more likely?
What a sell signal means is that prices probably aren't going to go up in the near term, but you can work off an overbought condition in the markets simply by going sideways. And we saw that a lot last year. We saw long periods where weeks markets just track in a range, and then finally they either break up or break down from wherever they were. So we've got the sell signal in place. Markets are likely going to correct. There's a tremendous amount of support below current levels. You have the 50-day moving average, which is now crossed above the 200-day moving average. We've got the downtrend line from the January peaks. We've got the rising trend line from the October lows. There's just kind of one support after the next between 3950 and 4000. So there's a tremendous amount of a base that price action will try to find a floor. Now, as long as the markets can kind of hold into that 3,900, 4,000 range, get oversold, and then turn back up, register another buy signal, and then make a move higher, then that's going to suggest this bullish trend is still in place. If we take out all those supports, which are very important, then that's going to suggest that the bears have now gotten back control of the markets, and then we could see a potential retest of the December lows. After that would be the October lows. When you look at probabilities of those events right now, the probabilities favor the bulls at the moment, but it doesn't mean that you can't get a more bearish outcome. So at least something worth paying attention to. But those support levels right around 3,900, 4,000, that's going to be a critical marking point for the market when we get there.
Because I just recorded it right before we're talking here, Lance, with Sven Henrik. Northman trader, very well-known technical analyst, basically said exactly what you just said. He said there's a massive battle for control going on right now. The bulls sort of seem to have the upper hand, but it's all going to, in his mind, like you said, it's going to be determined by what happens if indeed things correct down here into that sort of 3950, 400 range. And he said, basically, if that provides support and we bounce off of that, it's a really strong, solid green light that the market's going to run a good deal higher. In his eye, as high as sort of 4,300, 4,400 on the S&P.
Correct.
If not, if it breaks below 3,950 decisively, he thinks it could go as low as 32, like a real big drop, right? So he said, look, too hard to tell which way it's going to go. So we just got to watch the tape super closely. Talked a lot about what we've been talking about recently, Lance, which is, he said, this is the most challenging macro environment that he's seen in his career. And he said, from a technical standpoint, he's never seen a year with so many potential possibilities of where things could go. So that's his language of saying this is going to be the year of the audible, right? Just like you've been saying, right? There's just so many different things that could happen. We can't be wedded to any single one. We've just got to watch the action very closely. And, in Sven's language, use the technical analysis to really inform us of what is happening and what the probabilities in the near term are likely to be, and use that to kind of cut through the chaos, the emotion, the sense of what should happen, and really help focus on trading the markets we have versus the markets we either think we should have or wish we had.
Well, again, so I just wrote an article that it was out on, actually published it today on the website, talking about how the, investors are continuing to fight the Fed. And, at the bottom of that article, I kind of go through the targets for the market for the year. And basically it aligns a lot with what Sven said. I mean, our upside target, if you presume that, markets can trade at 18 times earnings on a forward earnings basis, and earnings don't decline anymore from here, which they're still continuing to decline, you can trade as high as 4,500. Downside's probably somewhere around 27, 2,800. So, but probably the reality is somewhere between 33, 3,400 on the downside and probably 43, 4,400 on the upside for now. And we may be range bound in that range for quite some time. We may rally, have a bullish buy signal here, get a rally to 43, 4,400. And then, the economic recession sets in or the slowdown and we trade back down to 3,500, 3,600. Then we rally back up to, 42, 4,300. It could be a situation because you're missing some ingredients for a raging bull market, right? You don't have the Fed increasing their balance sheet; they're reducing it.
Yeah, like any encouraging macro data, but yeah.
Yeah. Well, no, I'm just saying, between 2000, this is also part of that article that is on the website right now at realinvestmentadvice.com. But when you go back and look at 2009, between 2009 and the beginning of 2022, before the Fed started doing QT, both the Fed and the government had injected $44 trillion into the economy. So that's QT, that's quantitative easing, that's bailouts for HAMP and HARP and TARP and all these things. So you had this massive explosion in asset prices. The long-term return of the market is about 8% going back to 1900. Between 2009 and 2020, we averaged 12% annualized, which is 4 percentage points above what the economy can actually generate long term. That was all of that $44 $45 trillion worth of liquidity just getting dumped continuously into the economy. Well, you don't have that now. You've contracted liquidity by $500 billion since last year. You've got higher interest rates. You don't have zero interest rates. You got 5% interest rates, by mid-year with the Fed. 10-year treasury rates are substantially higher than they were. Mortgage rates are higher. So all that liquidity boost that you had to drive asset prices higher, you don't have. And here's the interesting, paradigm of all this is that everybody's hoping that the Fed's going to stop hiking rates. So we're running up asset prices because the Fed's stopping hiking rates. That's awesome. Run the markets up. The problem is if the markets are doing great and we don't have a recession and employment's still doing very well and the macro data begins to recover, if all those metrics are there, why is the Fed going to cut? Why would the Fed cut rates and why would they go back to doing quantitative easing? They're going to keep tightening their balance sheet. They're going to leave interest rates where they are for whenever the next recession comes. All that liquidity boost that was there to help drive asset prices higher isn't there, which means that we could just be very range-bound in prices for the next year, 2 years, 3 years, however long it is, until you actually do get the next recession wherever it occurs. And then you have to start doing all the liquidity boost over again.
So absolutely. And I want to share a couple of charts from that recent article you were just mentioning there, Lance.
Okay.
The first one is the chart you referred to a few minutes back when you projected out where you see the S&P could go.
Right.
And the key thing I just want to note about here is there's a lot more downside in this range than there is upside.
Correct. Right? Because of valuations.
Exactly.
Yeah. You're trading it historically. We're at 29 times trailing 10-year earnings. So, there's more downside because of valuations.
Yeah, exactly. So I just want to make sure folks realize where we are here, that yes, we might get another rush higher in the markets here, especially if they bounce off that key sort of 4,000 support like we were talking about. But there's not a ton of upside there, and there's definitely more potential downside if a lot of the factors you just talked about come to manifest here. So I'm just kind of raising the sort of nickels in front of the steamroller risk here, right? And I think your chart sort of does a good job of visualizing that. The other chart I want to put up here, just from what you just talked about, is this chart here of the Fed funds rate plus balance sheet contraction versus the S&P 500. And it shows what you're talking about, Lance, which is, the price of the index has been extremely correlated with the amounts of liquidity that the central bank has pumped into the system here. And we're all of a sudden now at the tail end of this chart, which is where the Fed is beginning to drain the pool again from a liquidity standpoint, and obviously make the cost of capital higher here. So, we saw that the index sell off in 2022. Logic would dictate, or at least strongly suggest, that if those trends continue into 2023, we should still see prices come down further, correct?
Well, yeah, liquidity is key, right? And this is the interesting part of the whole article, right? So the entire premise of the article is that for for 12 years, it was don't fight the Fed. Low interest rates, lots of liquidity. That gives you can discount, high valuations because of all this liquidity and zero interest rates. So you got a discount value on future earnings and don't fight the Fed. And what's interesting is now the mantra is turned to fight the Fed. This is now, don't worry about all this other stuff. Don't worry about the Fed hiking rates and raising that discount rate. Don't worry about the drain of liquidity from the markets. It's all fine. Don't worry about it. Buy stocks because they're going to go up long term. The problem is you can't have it both ways. It was either don't fight the Fed when they were juicing the markets with liquidity, or it's fight the Fed regardless, but you can't have it both ways. Somebody's going to lose this argument. It just depends on when.